On paper, the United States is the world's wealthiest economy. Stock indices hover near record highs, GDP continues to expand, and the dollar remains the global reserve currency. Yet beneath this surface stability lies a quiet tension. For tens of millions of Americans, one missed paycheck is enough to trigger a financial crisis at home. Paycheck to paycheck is not a metaphor. It is a condition where income barely covers monthly obligations, leaving no buffer for shocks. Rising interest rates have pushed credit card APRs above 20%. Rents and home prices climbed faster than wages for over a decade. Liquidity, once abundant, is tightening. When inflation spiked, savings eroded faster than they could be rebuilt. This is not sudden collapse but slow compression. Like tectonic plates building pressure, household finances strain invisibly, until a car repair, a medical bill, or a layoff exposes the fragility. The question is not why some Americans struggle, but why so many do, in an economy that appears from afar to be thriving. The earliest warning signs rarely appear dramatic. They show up quietly in household balance sheets. Emergency savings accounts shrink, then disappear. Credit card balances roll over month after month, no longer paid in full. Buy now, pay later plans replace cash for groceries and utilities. These are signals economists watch closely because they reflect liquidity stress at the micro level. When real wages lag behind inflation, purchasing power erodes even if nominal income rises. In the U.S., wage growth has struggled to keep pace with housing, healthcare, and education costs. Adjustable rate debt becomes more dangerous as interest rates rise. A family that could manage at 3% suddenly struggles at 7%. Delinquencies begin to tick up, not in headlines but in data tables. This is how systemic vulnerability forms, not through panic but through normalization of financial strain. Living paycheck to paycheck becomes routine, accepted, and invisible until the system is tested. An economic shock does not begin with collapse. It begins with transmission. Higher policy rates move first through bond markets, then into mortgages, auto loans, and credit cards. Liquidity tightens as banks reprice risk and lending standards harden. For households already stretched, this shift is immediate. Monthly payments rise while access to credit shrinks. Employment shocks amplify the effect. A hiring freeze or a small wave of layoffs reduces hours, bonuses, or overtime, often before jobs are officially lost. Exchange rates matter too. A strong dollar lowers import prices but pressures exporters and manufacturing jobs. Real estate, once a wealth engine, becomes a barrier as mortgage rates double. The shock compounds. Less spending reduces business revenue, leading to further cuts. This is not theoretical. It mirrors early stages of crises seen elsewhere, slow-moving, technical, and largely unnoticed until everyday life suddenly feels unaffordable. To understand why the United States is not immune, it helps to look outward. In 1997, the Asian financial crisis spread rapidly through currency pegs and short-term dollar debt, devastating household incomes across IMF-assisted economies. Argentina's repeated crises followed a familiar pattern: strong currency, rising debt, shrinking liquidity, and sudden loss of confidence. Greece, after 2010, showed how austerity and high unemployment can trap an entire generation in financial precarity. Turkey and Venezuela offer more extreme cases, where inflation and exchange rate collapse erase savings almost overnight. The U.S. is different. Its debt is in its own currency, its institutions are stronger, but the human mechanics are similar. When living costs outpace income and buffers vanish, families experience crisis long before nations do. Paycheck-to-paycheck living is not unique to America. What makes it notable is how widespread it has become in a country with unparalleled financial depth. Looking forward, the outlook depends less on growth headlines and more on distribution. Productivity gains and asset appreciation have continued, but they are unevenly shared. Financial markets can thrive while household balance sheets weaken. This divergence is dangerous. If interest rates remain elevated to control inflation, debt servicing will continue to absorb a larger share of income. If rates fall too quickly, asset prices may rise again, further distancing homeowners and investors from renters and wage earners. Credit default swap markets quietly price these risks, reflecting confidence in institutions but caution toward consumers. Liquidity will likely return first to capital markets, not kitchen tables. The path ahead is not collapse but pressure. Without structural adjustment, paycheck-to-paycheck living may become a permanent feature, not a temporary phase of the American economic landscape. Faced with these pressures, the response of the U.S., government and the Federal Reserve has been cautious and constrained. The Federal Reserve's primary tools, interest rates and balance sheet policy, are blunt instruments. Rate hikes were designed to slow inflation, not to protect households carrying variable rate debt. Fiscal policy has offered targeted relief. Stimulus checks during the pandemic, expanded child tax credits, temporary rent assistance. But most of these measures were short-lived. As liquidity programs wind down, responsibility shifts back to households. The Fed watches employment, inflation expectations, and financial stability indicators, including bank reserves and stress in short-term funding markets. Yet there is no mandate to ensure families can absorb a $1,000 shock. Monetary stability does not guarantee household resilience. The gap between macroeconomic success and microeconomic security remains largely unaddressed. For individuals, survival within this system is less about wealth and more about resilience. Families adapt in pragmatic ways. Spending is prioritized toward fixed costs, housing, transportation, insurance, while discretionary categories shrink. Multiple income streams become common, from gig work to informal side businesses. High-interest debt is refinanced when possible, though access depends on credit scores shaped by past stress. Cash buffers, even small ones, matter disproportionately. A few weeks of expenses can prevent a cascade of fees, penalties, and forced borrowing. These strategies are not about optimization, they are about containment. Living paycheck to paycheck forces constant decision-making under pressure. Every choice trades time, health, or future opportunity for immediate stability. This is the hidden tax of financial insecurity, paid not in dollars alone but in attention, sleep, and long-term planning. In the end, paycheck-to-paycheck living is less a personal failure than a structural signal. It reflects an economy where volatility has been shifted downward, absorbed by households rather than institutions. The United States remains resilient, innovative, and financially dominant, but resilience at the national level does not automatically translate to security at the personal one. History shows that systems rarely break all at once. They strain, adapt, and normalize stress until it becomes invisible. For viewers, the lesson is not alarmism but awareness. Understanding how interest rates, credit conditions, housing markets, and policy decisions intersect with daily life is a form of protection. Financial stability is not guaranteed by optimism, nor destroyed by realism. It is built slowly, deliberately, and often quietly. The question is not whether the system will change, but whether individuals and institutions will recognize the warning signs before pressure becomes permanent. What often goes unspoken is the psychological weight this reality creates. When income equals expenses, time horizons shrink. Long-term goals, education, entrepreneurship, relocation, are postponed indefinitely. Risk tolerance collapses even when opportunity appears. This is observable in data. Lower household investment participation, reduced mobility, declining small business formation among lower-income groups. In macro terms, this weakens economic dynamism. In personal terms, it narrows life choices. Countries like Greece after the debt crisis saw similar effects. Talent stayed put not from loyalty but from constraint. The U.S. shows early echoes of this pattern. Paycheck-to-paycheck living does not just respond to economic conditions. It reshapes behavior in ways that can reinforce stagnation, quietly feeding back into the system itself. History suggests that prolonged pressure eventually forces adjustment, but not always in predictable ways. In Argentina, repeated cycles of inflation and currency controls pushed households toward dollarization and informal finance. In Turkey, rapid rate changes distorted credit access and accelerated wealth inequality. The United States will not follow these paths directly, yet the signals rhyme. When real estate becomes unaffordable, household formation slows. When liquidity is scarce, consumption weakens despite strong employment numbers. Yield curves, CDS spreads, and bank lending surveys already reflect this tension, confidence in sovereign stability paired with caution toward consumer credit. These indicators rarely make headlines, but they shape the environment households live in. Paycheck-to-paycheck existence is not the end state of a crisis, it is the midpoint. Whether it resolves through rising incomes, policy reform, or quiet adaptation will define the next decade of American economic life. There is, however, a distinction between inevitability and acceptance. Structural forces set the stage, but outcomes remain negotiable. In several northern European countries, stronger wage indexing, lower household debt exposure, and universal social buffers reduce the share of citizens living at the margin. These systems trade flexibility for stability. The American model has favored dynamism, assuming growth would compensate for risk. That assumption is now under review. Without adjustments, whether through housing supply reform, healthcare cost control, or income smoothing mechanisms, pressure remains individualized. For households, this means self-insurance becomes the default. For the economy, it means volatility is hidden, not eliminated. The paycheck-to-paycheck condition persists not because Americans misunderstand money, but because the margin for error has narrowed across the income spectrum. A complete understanding requires stepping back from numbers and returning to lived reality. Economic indicators describe conditions, but they do not experience them. A rising interest rate is a statistic until it becomes a higher monthly payment. A tightening credit market is an abstraction until a loan application is denied. Across history, from IMF restructuring programs to domestic austerity cycles, stability has often been preserved at the system level by transferring risk downward. In the United States, paycheck-to-paycheck living is the visible imprint of that transfer. It is not a warning of imminent collapse, nor proof of decline. It is evidence of friction between growth and security. For viewers, the realistic perspective is neither fear nor complacency. It is recognition. Financial pressure does not announce itself loudly. It accumulates, reshapes behavior, and defines boundaries. Understanding those boundaries is the first step toward navigating them, individually and call. Ultimately, the question of why so many Americans are stuck living paycheck to paycheck is not answered by a single chart or policy decision. It is the result of compounding forces. Interest rates set to stabilize prices, housing markets shaped by scarcity, credit systems built on leverage, and wages adjusting too slowly to absorb shocks. For decades, the system worked well enough that stress remained episodic. Today, it is continuous. Compared with crises in Venezuela or Turkey, the U.S., situation appears stable. Compared with Northern Europe, it appears fragile. Both views can be true. The realistic takeaway is not despair but clarity. Economic strength at the top does not automatically insulate the base. Until household resilience becomes a policy objective rather than a byproduct, paycheck-to-paycheck living will remain a defining feature of American life, quiet, widespread, and shaping decisions far beyond the next payday. Reflection matters because systems change only after narratives do. For much of modern American history, financial stress was framed as temporary, something growth, education, or discipline would eventually solve. But when 70% of households report living paycheck to paycheck at some point in the year, the pattern is no longer marginal. It is structural. This does not negate personal responsibility, nor does it demand catastrophe. It demands realism. Just as central banks monitor liquidity and governments track debt sustainability, societies must measure household shock absorption. Without it, stability becomes cosmetic. The dollar may remain strong, markets may recover, and institutions may endure, while families continue to operate without margin. The final message is not pessimism but orientation. Understanding where pressure accumulates allows individuals to plan defensively and institutions to respond intelligently. Paycheck-to-paycheck living is not the end of the story. In closing, it is worth remembering that economies are ultimately reflections of lived experience. Indicators like GDP growth, interest rate spreads, or sovereign credit ratings describe capacity, not comfort. The paycheck-to-paycheck reality reveals where capacity fails to translate into security. For some viewers, this recognition leads to personal recalibration. Lower leverage, higher liquidity, fewer assumptions about stability. For others, it invites broader questions about policy design and social priorities. Neither response is wrong. What matters is grounding expectations in reality. The United States is not facing an imminent financial collapse, nor is it delivering universal prosperity. It is navigating a narrow corridor between the two. Paycheck-to-paycheck living marks the edge of that corridor. Seeing it clearly does not solve the problem, but it prevents denial. And in economics, as in life, clarity is often the most valuable asset of all.